Good morning and welcome to the Leadership and Insurance podcast. I'm your host, Alex Bond. I'm very lucky today to be joined by James Poole of Agile Risk. James, good morning.
Hi, good morning, Alex. How are you doing?
Yeah, I'm all right. I know I've just remarked on this, but I am loving the backdrop. You're looking like the mad professor of insurance.
Yeah. Someone sent me a picture of Bezos with some similarly scrawled on the back of his or the side of his wall, which is quite funny. It said Amazon in big writing. Maybe I should have a big A for Agile too.
There's not any secret sauce up there that we should be, hiding or.
Yeah, I'm not sure really. I think what we're looking at is the perennial structure of risk-adjusted returns on capital, and they've never changed for the term of the last 300 years.
Oh, okay. So that's definitely not a secret then. Well, look, James. Obviously, you and I have spoken previously, but for the people out there that don't know you and your business, it'd be great if you could introduce Agile Risk and what it is that you guys do.
Sure, we're a venture-backed risk intermediation team in London, and what we're trying to do is drive down the total cost of risk for clients. Mm-hmm. And we're doing that by creating a new asset class, by securitising risk. There's traditionally been the resolve of traditional reinsurance markets, or is too difficult to insure or transfer entirely. We've seen the 25-year-old cat bond structure, and we're synthesising that in a slightly different context to create value for our clients, but also to create risk-adjusted returns on capital for capital providers in private capital markets, institutional investors and pension funds, family offices in some cases too.
Yeah, fantastic. Good summary. That's what I love about getting entrepreneurs on. They've got a really well-practiced summary of the business.
Engraved on my heart somewhere. My wife is, not again.
Well, at least you don't have to say you're an insurance headhunter and then everyone leaves the room.
Perhaps.
I will tell you a slight story. It's a massive deviation, but I once went to a party. My friend is a musician, and he's achingly cool. And it was in Dalston, obviously, and it was in a flat. And we went there. We didn't realise it was like the rollout of like the labels kind of party, but they just happened to be hosting it at his flat. So every single person there was like a DJ or like a musician.
Oh, cool.
And he came up to me halfway through because it was like me and my partner at the time, who was she's an accountant, and I was like in insurance. And he just came up and he was like, "Mate, can you stop telling everyone you work in insurance?"
Yeah.
Just tell them you're a stand-up comedian, because I've done like one stand-up gig.
Oh, okay.
And then the funniest thing was, because everyone found out that my partner at the time was an accountant, they all desperately wanted to speak to her to see how they could lower their tax. So she built up this. I wasn't cool because I worked in insurance, but she's in the corner.
But a tax accountant was. Goodness me, the times we live in. And actually, maybe a reflection on East London. I live in Bethnal Green, so whilst not achingly cool, I am pretty cool. And but we're getting to a time where tax accountants are in demand from cool party goers in Dalston. I mean, magnificent.
Yeah, I know.
It's funny old world, eh?
YouTubers looking for tax advice. But no, we digress slightly. So, the business you're talking about, I mean, I remember you explained it to me, and I just kind of leaned in and I had this thing of going, well, surely that's been done before. But clearly it hasn't. And what is it that you're doing that's kind of, that you're proposing that's different from the kind of status quo?
Okay, well, challenging the status quo, I think, sounds a bit visceral. It sounds a bit loaded with emotion. So I choose to frame things in terms of our purpose, right? So I think of the purpose of a business being to create something, to make a difference or move something forward. And the purpose of our business, for example, is to drive down total costs of risk for our clients. This is like a universal objective that every human, every business has, right? A risk is a cost to the bottom line. Everybody resents paying insurance premium because they're not getting anything they perceive back for it. Some security, and some people sort of frame this, the capacity for risk or the enablement of taking entrepreneurial risk as something that you get back for your insurance premium. But the objective that people have around the world and have always had, we think, is to reduce this total cost of risk. It's a universal principle. So the way we're going about doing this is by creating a new asset class. There have been people who have successfully transferred some direct and facultative reinsurance risk to capital markets before. This hasn't systematically worked, or it's been more of a sort of one-off situation. But there is a increasing demand for insurable risk in capital markets, not least because of the negative yields that the investor teams are facing in capital markets. So we're sort of we're looking at one principle being everybody wants to reduce total cost of risk, and the other principle being it makes sense to invest in reinsurable risk or anything else for that matter, where the risk-adjusted return on capital exceeds your weighted average cost of capital, because that creates value. That margin creates value. So when you think about, you certainly can think of it as challenging the status quo in some aspects, because we're proposing to do things differently and to create something. But I prefer to look at it, to base this on first principles and base this on the purpose of a business, which is a bit more positive sounding. But it's, I guess it's the way you tell them, right?
Yeah, that's true. That's true. It's a podcast though, so we like to be challenging. We like to say we're challenging the status quo. Doing something productive, like you're creating something, that's no good for me. No, I totally understand, and the nuance of language there, I think, is important. And as you touched on, it's like this has been done, but am I right in kind of looking at it from, it's not been productized, it's not been kind of done at scale, and that's essentially kind of where you're proposing.
And there are a number of hurdles to this. One is cultural aversity to change, and I want to talk a bit more about that. But the other is the perception of there being insufficient data in this particular area of insurance risk, the risk being too complex to understand somehow. I'm a bit of a skeptic of that, because capital markets are structured around allocation of real debt and equity capital and cash, whereas insurance markets are purveyors of intangible promises to pay claims that everyone hopes are never called upon. I mean, that may sort of indicate something of the sort of relative attractiveness of insurance capital markets respectively, but there are some cultural factors too.
I wanted to talk to you about culture, because I think that's where I was going with a question about status quo. There is definitely a entrenched way. London's a very microscopic, but it's exaggerated in London, exaggerated in Lloyd's certainly, but there is a kind of, when you challenge things that have been done before, the idea that you simply don't understand, or it's far too complex for that. How important do you think culture is in driving change?
Well, culture can be a sort of a major obstruction to change. As far as what I'm experiencing now, can be taken as evidence of this. I mean, sample size, etc. But it seems sort of fairly common sense that culture is a fairly major obstruction to change, and we've come across sort of two particular cultural barriers to innovation in our particular context and in the insurance market. I mean, the first of these is the way that people are conditioned to look backwards in time. People are conditioned to look at the claims history, to look at the loss record, and this is changing to some extent. I have to say, because of the forward-looking risk models. Monte Carlo simulation models are used by most teams in the risk transfer world, but it's still relatively new as a concept over the sort of 300-year-old market term. So, and cultural change is sort of famously slow. But having this sort of this hindsight millstone round your neck kind of does drag things along, and it does make it difficult to innovate. I think there's a second thing that we've noticed that hinders change, and is a sort of cultural factor, is this is the law of big numbers. So the law of big numbers and the ability that it presents to diversify portfolios of different risk exposure is a first principle in insurance. Everyone sort of thinks, but for the portfolio. But this is like a complete cultural opposite to the minimum viable product approach used in entrepreneurship.
Yeah.
So that may be a hinder culturally to innovation too. There are people who are vested in the status quo inevitably, and the timing of innovation change is difficult. Also, people are culturally, people are sort of tend to be averse to change in every fashion. It's quite a sort of human reaction to these things. But other than, I think there are only sort of three perennial certainties, only three constants in life, and they are change, principles, and choice. So the world is always changing. We have to reposition ourselves, restructure, and reconfigure things all the time, and businesses are, of course, part of that.
No, I think that's a really important point. Very smart man, a friend of mine, Bruce, has always said to me that people never change their mind in the room. And his point being that, exactly that. I think people's gut reaction is to kind of say, is to resist change. It doesn't mean they won't go with it. It just means that the kind of that kind of natural reaction is to say, it's just fear, is it? It's learned behavior to kind of protect yourself. But I see that in my world. So when we're sort of looking at new talent, if someone leaves or resigns, it's very common to say, we've lost James from our team. We need to find someone like James to fill that gap. And the best businesses and the most exciting businesses I work with, they say, right, we've lost someone. What's our opportunity here? Can we bring in different skills? Can we bring in different thoughts with this individual? But there's a reason why that's quite rare, and those businesses tend to be quite successful. It doesn't mean that person isn't the right person, and actually the profiles can be very similar. But at least to inquire about whether you could do something differently, and I think that does kind of lead to culture. But one thing that's kicked around my mind a lot, and a question I know that I kind of posed to you before, is insurance, can businesses be too profitable to change? So if it ain't broke, don't fix it kind of principle. And do you think some of that applies in insurance?
I don't know. Okay, sort of zoomed out a little bit. There's no like fundamental requirement for a business to change at all, kind of just for the sake of it, right?
No.
But I think that the change is driven by the purpose of the business. And the purpose of the business will define how and if it changes over time. I sort of break things down into two stages. The first stage is about racing to get the venture cash flow positive as soon as you possibly can. And the second stage is about generating enough sufficient cash on a sustainable enough basis to enable the team to deliver on its purpose. If it can't do this with the current configuration of resources and capabilities, then it does need to change things. Simple as that. So if the sole purpose of a business is to enrich its shareholders and enrich the private equity owners of the shell company in the Cayman Islands that pays no tax but owns the business, and people are still happy to work for this business in a way that is commensurate with the purpose, then no problem, no need to change at all, I guess. High levels of M&A and consolidation in the insurance industry right now would seem to suggest that things do need to change, and new operating models are required. So rather this being a business that's somehow too profitable to change, Alex, I think it's the other way around completely.
No, I would agree with you. It goes back to my contrarian questioning. I mean, I completely agree, but I think that's some of the argument sometimes is that if it isn't broke, don't fix it. And that's where the change resistance comes from on an individual basis. But absolutely, you're right. If you step back and you say, well, the industry's had profitability problems as a whole, you know, and you spoke to something there which you know was obviously actually very core in my belief system, is that, you know, that businesses created that only serve to kind of make profit for shareholders are naturally imbued to be resistant to change, because essentially you're saying, we want to not pay you out that big dividend because we're going to reinvest that money, which will be realized in net gains in maybe 20, 30 years time, because we've become the dominant player as a result of the investment we make now.
Or just paid as coupons to your private equity fund investors.
Yeah. So it's a very difficult conversation to have. It's a very difficult long-term view to have. And maybe that's the problem. I mean, maybe there is a problem in that, and that culturally, even with startups, speed is kind of valued so highly. You know, it's not enough for you to get there. You have to get there really, really, really quickly.
That's a good word for that as well. Begins with A. Being agile. Sorry, just.
I was going to let you say it. I wasn't going to give you the pleasure of me filling that in for you. But I'm often reminded, like Warren Buffett said, you know, he said, I'm going to massacre this quote, but there was something along the lines of it. He gets asked all the time how to get rich quick, and he doesn't know how to get rich quick. He knows how to get rich slow, because that's the only way. But there is definitely something countercultural to business ethos as we know it. And coming back to that kind of minimum viable product, where the kind of insurtech world, I think, is at odds with particularly insurance, but I think just tech generally, is that I totally understand this kind of consistent iteration and continuous improvement, minimum viable product. But I do think there's an inherent risk in that kind of thinking and model, because sometimes it's kind of about speed over kind of being able to take a kind of long-term view about, is it the right thing? And that's without getting involved in any sort of ethical, you know, environmental concerns or kind of ethical concerns in kind of terms of kind of value chains. Just kind of stepping back and going, well, is this the right thing to do on the longer scale? So,
good question. I mean, timescales and people's objectives over those timescales variously do vary, don't they? And you know, I'm a millennial. Okay, I wave this flag saying I'm a millennial because I think I'm just a millennial by about a year. I was born in 1982, which I think the cutoff is 1981. So I'm very happy to say I'm a millennial. But maybe people talk about millennials being, you know, focused on purpose. I believe that, but also the horizon that I'm looking at, the investments that I'm making as a business now, and looking at the horizon that I've got in terms of a career ahead of me, they're quite different from somebody who's, you know, maybe quite as old as you, Alex, or significantly older than that.
Well, I was born in 1981, so
okay, so you are millennial too. my joke kind of backfired. All right, fair enough.
So thanks for that. But look, I think we touched on it a little bit there, actually. You know, we've both worked in the insurance market. You much more significantly than I, and much more successfully than I. I wanted to ask you about your experience a bit. You know, and I think this goes into that kind of change bucket. Do you think the leadership of insurance, particularly, is still quite elitist? Is it still too centralized? I suppose do you think we need to encourage greater diversity, and then we'll see more embracement of new ideas?
Well, okay, interesting. I'm not sure if insurance is all that elitist. As far as I'm concerned, insurance is a bit of an ugly duckling in terms of the City of London, at least. Or maybe it's just a sort of ugly duckling in comparison with investment banking and consulting and law. But it's probably fair to say that elitism in the market has been an issue. I mean, I probably didn't go to the right school to get into the upper echelons of executive leadership of city insurance market businesses right now as they stand. But the question of, is greater diversity required? Required for what? I mean, if you mean, is greater diversity required to ensure that the London market remains relevant as a market, marketplace for solving risk problems? Probably yes, because solving risk problems requires you to understand the language, the people, and the local dynamics in any particular situation, wherever you are in the world. And diverse teams that reflect the world that we live in would seem to be likely to make us able to solve these risk problems better. And it would seem to be likely to be a better way to structure upper echelons of executive leadership in the city.
Yeah, well, I mean, it's statistically more diverse. Certainly, more diverse leadership teams have businesses that perform consistently more profitably and successfully. But I've never seen the breakdown of the microcosm of why people think that is. I mean, I think more ideas and better ideas is usually kind of where I'm looking at and go, well, that's always the kind of better way of looking at it. But certainly kind of in the way
better or different ways of looking at it, right? I mean, because we can all be looking at the same fact, but if the lens that we use to look at that fact is different, then we could always get a different take on that from our own perspective. And I think that enables us to look at, not wanting to sort of peddle the metaphor too much, but 3D, different color perspectives, this kind of thing. I think I'll leave it there.
No, and I think that's where I was coming from on the kind of elitist was a terrible choice of word. Probably type that out in a very tired moment, but I think narrow in terms of kind of the worldview, and I think that's kind of where I was coming from. You know, the pool of talent, particularly at that leadership level, is pretty narrowly, picked.
White, bald, middle-aged. You mean like the two of us?
Yeah, I mean we're growing into those people. But because we're still millennials, we're too James. That's the problem. That's what it is.
That's right.
Yeah, I'm gonna leave it there. What I wanted to pick your brains on is about other forms of capital, alternative forms of capital, hedge funds. Obviously, insurance is intertwined to a certain degree. But do you think insurance could benefit from more directly engaging with other forms of capital? Because it seems to me that there's just things to learn, a lot of things to learn in kind of the way they approach risk, the way that they kind of, through modeling, for example. I wondered if you could speak to that, because I know that you've been engaging directly with alternative capital.
Yeah, sure. Firstly, I think that convergence is inevitable. So I don't really look at it like there being a cost benefit or pros and cons of greater interaction with capital markets. I think it's inevitable. And early on in my career, I finished my morning of standing in queues waiting for underwriters at Lloyd's of London. And I walked 200 meters north up Bishopsgate to where my flatmate worked for a hedge fund trading German government bond futures. In a little less than an hour, I watched him win in 10 trades and lose in 6, and his account was up 10,000 euros. And I then walked back to Lloyd's and queued for another 2 hours before spending 20 minutes talking about a single risk with Syndicate 510, negotiating about the provision of capital that's dressed up in hundreds of pages of terms and conditions. It's contingent upon there being a claim, and which no one wanted to ever call upon anyway. So since then, I've been sure that we'd see convergence between insurance and capital markets. Deloitte valued global reinsurance markets at 2.5 trillion in 2018. And around the same time, McKinsey put a number of 300 trillion on global capital markets. So it gives you an idea of the sort of the scale and the subset we're talking about here. If we call treaty reinsurance half of this 2.5 trillion that Deloitte put on on the market, then where cat bonds have existed for about 25 years now, then we've got about 1.25 trillion of direct and facultative reinsurance risk yet to collateralize. So, yet to transfer to capital markets. So these are markets where investors are otherwise faced with negative yield. So it's about communicating and translating some of the differences in jargon, terminology, esoteric nature of the transactions and some of the history between the two markets, because they're both they're both challenging to interpret from the outside. But because of and it's now a few years on from my stroll up the road to watch German government bonds get traded, it now actually costs you money to lend your cash to the German government, and the negative yield is accentuating the likelihood of this convergence. The negative yield in German government bonds, however, isn't as bad as the 10% loss of gross margin or negative yield that was derived from underwriting risk at Lloyd's last year. Funnily enough.
No, I agree with you. It's there's a little bit of education. There's a little kind of clearing up the terms. I mean, we were having a conversation, and I just you put it in really simple terms to me and saying that essentially translating it into insurance speak and then translating it back, and certainly kind of some of that going on. But I was interested that the conversation we had before, the appetite in some of those alternative markets when you've presented some of the returns that are possible. The scale of that appetite was quite shocking to me. Maybe it's not shocking to anyone else, but it was just kind of the appetite appears to be there for the business.
Indeed, no, it's the low correlation nature of insurance risk versus the yields in government bonds is well celebrated. There's a huge suggestion and movement of people who are very encouraging of the insurance market being able to push the ESG themes that are evident through this market too, to attract more capital. But capital isn't the issue.
No,
there's a sort of global surplus and capital abundance in capital markets, and the insurance market currently is in distress because of for income reasons. There's not a limit of capacity standing on the wings, looking, circling, waiting for risk-adjusted returns that are driven by underlying insurance risk. So it's quite a to think of insurance being super complex, different, not understandable to anybody else outside is a little narcissistic. I think it does make the translation of jargon terminology a thing, and it's a translation exercise as much as it is me requiring an Oyster card to get onto the underground at Bank Station and go 15 minutes west to Bond Street to Berkeley Square. I mean, there's a world away in terms of the terminology we're using, the analytics we're using, the understanding of risk. But capital markets move real cash around rather than promises that are contingent upon solvency and could be defaulted upon by risk carriers, however well they're rated. So that's the difference. I mean, I read in about 2018 that this was Oliver Payne in the Financial Times reported that on average it took FTSE 100 companies, the largest companies in Britain, on average 19 months to get their claims settled.
Wow.
I mean, that's incredible. I then, to sort of, because I was a bit concerned about how the capital markets might handle things in contrast. Well, I asked a few people, and they said that for the structure you're proposing, you can expect I don't think settlement is possible within 48 hours, but it would be within 72. So,
Wow.
I mean,
Wow.
there may be capital efficiency, costs of capital reasons to do these trades, to transfer risk to capital markets, but there's also time value of money based attractions too.
Yeah, I mean that's the thing that the claim cycle's always been hugely inefficient. And look, you know, I'm not saying claims should be paid when they're not due, but you know, you look at that process, and you know what someone's buying is a promise to pay. It just it's overwhelmingly long-winded in terms of kind of getting to that event, and then that kind of devalues what you've purchased in the first place. You know, it's fine. It might be fine if you're a FTSE company, but we take that down a notch and we look at smaller organisations as well. You know, that's the difference between someone staying afloat or someone not. So
it may be existential, as you say. I mean, COVID, we've seen that recently, haven't we? I mean, the payback, the bounce back loan facility from the government has, you know, enabled people to remain solvent for a longer period of time. Now, whether these are sort of walking wounded or whether these are zombie companies is a matter of debate in some situations. But cash, quick cash, instant solvency is a thing. It's a valuable resource.
I'm interested to see, you know, working in a marketplace. There is a bit of groupthink going on. I wanted to ask you the question of how do you escape being like captured by the culture? Like how do you think differently in an environment which is kind of potentially resistant to change?
Well, risk is any uncertainty affecting future cash flows, right? So why can't we build an agile team that uses data analytics to look at any kind of reinsurable risk exposure? Why can't we use cat bond structures in other insurable risk contexts to transfer risk to private capital markets? For me, thinking differently has been about standing back and asking why? It's been about presenting an anonymized cash flow model for a standard reinsurance transaction to a hedge fund who couldn't believe what they were seeing, and then trying to help them to navigate the jargon, terminology, smoke and mirrors that the insurance industry uses to dress things up in. But where leaders and boards are virtually all of one thing in particular or another, and where middle management are clinging onto the status quo for dear life for the last 5 years of their career, understandably, things become intransient and people and businesses become averse to change. Groupthink becomes a thing, binding people together.
Yeah, no, I completely understand, and I think, yeah, middle management is. I mean, look, middle management is always the thing that's a threat with any technological change, right? Because essentially, you're usually making something more efficient, whether it's communication or process, and that's usually the fiefdoms in which kind of a middle management role would sit. It's generally administrative, and it's kind of either distribution of work or communication, or you know, it obviously can be more than that. But if we kind of distilled it down, that's essentially where a lot of these roles sit, and they're very valuable. But when change happens, it can make them unnecessary. You know, new processes, new structures, new technologies that kind of replace some of that. And I think but it is where some of the power's held. So the kind of resistance to change is driven from there. So I think particularly that kind of middle management though is exactly where the resistance to change happens. So
yeah,
that does kind of lead back into what we were talking about before. And I think that's where diversity of thought, certainly in the kind of actual genuine leadership of a business, is incredibly important, because they can look at these structures differently. It's a bit like bringing in people from outside the insurance industry to come and work in the insurance industry. You know, what's to stop us hiring the best people from open banking to kind of come and look at the way that we're challenging insurance?
Well, if you do, you'll be beating me to it. No, definitely. There are large scale restructurings that can be learned from. There are financial innovations on a kind of system-wide basis, like open banking, to be learned from. But there are risk modeling capabilities to be learned from. There's structuring opportunities to be learned from, and we should be outward looking in terms of trying to put together as many different perspectives on these things as we can. It gets a bit of a challenge because asking everybody's opinion and it being different means that we have to be quite effective at saying that it's not bogging us down and us still being committed to action. But yeah, more diverse thought, I think, has got to be absolutely fundamental.
You've I was going to ask you about an MBA because you studied your MBA. Do you think that's helped with the way that you approach business and the way you thought? This is selfishly because I'm considering doing an MBA, and but as someone that works in talent and acquisition of people, I'm surprised. I see quite a lot of people that do the MBAs, but not in the kind of context of like the American system where almost everyone does an MBA before starting work. I don't know if we do enough continuous learning, and I think an MBA is a really valuable thing to pick up if you're going to be someone like an insurance executive. Do you think it's helped you?
Yeah, I do. I didn't have a first degree, and this meant I couldn't go to a particularly elite or prestigious business school. But the Open University in the UK accepted my chartered insurance broking studies as an entry point for my MBA. And this meant my MBA was all about inordinate number of Saturday mornings and weekday evenings, learning about things like efficient market hypothesis and wondering about the inefficiency of the hypotheses in the London market insurance businesses in contrast, frankly. I mean, quite a few management theorists seem to be on sort of completely different planets from me, and management mumbo jumbo is a real thing, Alex. I reckon. But my MBA gave me tools in strategy and cash flow modeling, which has enabled me to not just think about different ways of doing things, but to actually raise capital for a new business and to get to day one and actually do it. And the ACI was a vital stepping stone for me, as I couldn't have got into business school without it. And my ACI helped me to learn that insurance comes down to 5 common principles, and whichever insurance type or class you're talking about too. So there's, I guess, the possibility that insurance as a sort of uniform entry point and box ticking exercise could be thought of as a driver of groupthink that you mentioned previously, but I don't think this is so. I mean, I think that groupthink is more driven by the number of people with the same interests and not enough dissent. But as in terms of education routes and the validity of ACII and MBA and other things, I'm about the last person that should be consulted on education timing, on content, on pathways, because I've taken a very, very unconventional route.
But I think your route speaks to something, because I in my world it's really interesting that the fundamentals of insurance. There's some parallels. The fundamentals of how I do my role, of how you work as an executive search consultant, don't change dramatically. You might have different tools, and there's slightly different nuances, and there's different businesses that you're working with, so the profiles change, but the fundamentals don't, and therefore kind of you're not learning enough from outside influences to kind of potentially change and challenge the process. And I think where I was kind of intrigued, and I think the ACII is really important, because you can't challenge things well if you don't know the fundamentals. It's a bit like you're trying to propose something which is slightly different in the world of reinsurance, but if you don't understand reinsurance really, really well, it's going to be very difficult to kind of challenge that status quo.
That's definitely the case.
So you need to ACII to break it, but I just wonder whether we could expand upon this kind of thought process of continuous learning. And I think things like MBAs are pathways to that, but potentially there could be more done from a kind of centralized point from insurance. And as things like data science become more intrinsic in our business, and understanding data as an executive, for example, these sorts of skill sets, because that's enabling more ideas to come into the business. So I think someone taking the sort of, as you put it, the sort of more indirect pathway to more education. I think we need more of that, and I just don't think we see it enough.
Yeah, for me, I think the sort of continual professional development thing is all very good thing, all that kind of stuff. But I look at it in a slightly different way. When I started in my career, I saw, as I said, this big contrast between insurance and capital markets, and thought consolidation will happen. Commoditization of credit markets happened. That was a massive disruption to capital markets and banking. You've got stockbrokers used to be wearing pinstripe suits, walking up and down roads around here, and there aren't many of those now. They're websites. So that's an area too. This open banking initiative is incredibly interesting, and it passes the power of the ownership of data onto the principal, and not people who are intermediaries in the chain that own that data. So that's interesting too. But for me, my MBA, I guess, has been a sort of a lens through which I can see these different problems. I mean, in some areas, it's been so focused that I've been really quite disappointed with what I can see around me. But that has only helped me to understand why it exists as it does, what the opportunities may be to do things differently, and then also how to surf a wave of convergence, which is what I foresee. I mean, this is what Solvency II is mandating, making a requirement too. The ultra high levels of operating leverage that have been possible through reinsurance for 300 years are starting to be unwound. Is it going to be sudden? No. Is cultural change sudden? No. But it is really happening. So what probably happens, I think, I can't be completely sure because I could be standing in queues in Lloyd's of London in 5 years' time, but what probably happens, I think, is that reinsurable risk moves predominantly, direct and facultative reinsurance moves predominantly to capital markets, and I want to use this to drive down total cost of risk for my clients, because that's a universal objective of everybody.
Well, I think it's not. I think that's part of the problem. I think that's why you wanted something. But no, I completely agree with you. But James, I'm conscious of our time, so I think that's a really nice and neat place to end on. So we hope not to see you into a queue in Lloyd's in 5 years' time. We hope to see you running.
Listen, I don't mind queue jumping to get a coffee. Okay, and I foresee. I think what Lloyd's really should be and do and structure itself around is a facilitator for managing general agencies, because you've got 300 years ago, the vehicle that was being used to innovate, to push things forward, to create things, was the syndicate. But I think now syndicates are strategies for large corporates around the world, but the tool, the operating model that is being used and can be used to innovate is the MGA. So Lloyd should be focused around MGA teams and risk advisory teams like ours, but that should be the focus of this. And so when it comes to queuing in Lloyd's, if I'm having to queue in Lloyd's for reasonably priced coffee and in advance of a very good business meeting with a team of really innovative underwriters and MGA folk, then bring it on, quite frankly.
Yeah. No, I like the sound of that. I'm a big fan of that model. So, as we see on previous podcasts, I might even shamelessly plug another podcast about MGA, but I won't do that. But James, thank you so much for your time. Really appreciate you being a guest, and yeah, I look forward to keeping in touch.
Fantastic. Thank you. Thank you.